We're at a point of inflection right now. We have seen several months of weak PMI, but not weak exports. There is an element of front loading there, and even the latest numbers from China suggest that good numbers continue. But I think we're about to start seeing bad numbers from the trade side. So the reckoning, in my view, from trade wars, waning confidence about the earnings season will start manifesting as we progress through November and step into December. So I think that we're at a fairly critical stage. You can sense the nervousness on the market side with the U.S. market sell-off overnight. You could argue that those were idiosyncratic factors related to GE or Apple, but I think generally speaking, even from an Asian perspective, there's an inflection point just around now.
Okay, well, how do you prepare yourself for that inflection point, and how do you trade then that scenario that you just outlined as just around the corner?
So primarily on the FX space, we think the dollar will continue to strengthen, even if there's a lot of talk about the Fed relenting at some point next year. We think that as far as the Fed communication is concerned, it'll be very positive for the dollar, and the dollar will head from the current 97 range that we have toward 100. That, of course, would mean significant additional weakness on the euro's part and the yen's part. And within the Asian space, on the FX side, China going past 7, of course, is the big story to follow, and that, of course, will pull along with it the rest of Asia complex.
Okay, so what opportunities then would there be to take advantage of that scenario? If we've got dollar rising, we see weakness in other currencies, as you outlined, how do you position your portfolio?
So I suppose the thing to play is that if there is going to be a temporary respite on the oil side, can the Indonesias and Indias be opportunistic buying points? And that's the key question. We saw last week when an Indonesian corporate tapped the external funding market, it got very well subscribed, and a 3 to 5 year paper yielding 6 to 6.5% was very well received. So clearly there's still appetite for decent yielding, high quality credit out there. And if indeed our worry about the current account sustainability of the Indias and Indonesias were to ease on the back of a softening oil backdrop, perhaps there would be some buying opportunities there. But I do hasten to add that these would be temporary respites. I don't see the soft oil environment lasting more than 3 to 5 months. So, take advantage of the narrow window, if you will.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.